Let's go to East Africa now, where the Central Bank of Kenya took a giant leap today when it unveiled the first ever 30-year bond in the Kenyan economy. Many expect the 18 billion shilling bond with an interest rate of 12% to bring great excitement amongst pension funds and life insurers who have struggled for a long time to match the age profiles of their members with maturity tenors available in the market. Joining us now from Nairobi to discuss the first ever 30-year bond in Kenya is Fred Mweni, Managing Director of Tsavo Securities. Good evening, Fred.
Yeah, good evening.
Also joining us in studio here is Kobe Lichranch. He is with Access. Fred, let's begin with you. Give us a sense of how the market received the news of this bond.
It was well received. First of all, towards the end of last year, I'm a member of the MLF Market Leaders Forum. We had intended to be able to go beyond 25 years, but I think the time was too short and we couldn't do that. So when it came this January, we decided that in this first quarter, we may want to do a 30-year bond to see how the market is going to react. I think the market has been prepared because we have the pension and trust funds as well as banks that participate in the second market that wish to get such an instrument. So in terms of reception from the market, I think it was being expected, and I think it's been well received.
Just give us a sense of what's the longest tenor bond that you currently have in the Kenyan market?
We have a 25-year paper, which was issued around September last year. In fact, this is what happened. When it came in July, it came at a coupon of 11.25. It was oversubscribed, and the average came at about 10.5. Then when it was open in September, the average actually came down to 9.83. So as we speak right now, that paper has not done very well because the amount of in the market is less than 7 billion. So for the 25-year paper, not so much trading, but the 20-year paper, we have a 20-year paper in the market, which was very, very active last year. I think it did more than 30 billion Kenyan shillings in the secondary market. So in terms of the long end, I think the market has been used to having a 20-year paper, a 25-year paper. The 30-year paper is the first time it's coming in the market, but I think the coupon of 12% is some of the coupon that we have never seen in the market for the last 3 to 6 months. Yeah,
and how have those bonds been trading, particularly those long tenor bonds?
Honestly, the 25-year paper has not been trading. The reason is when it came around September, the interest rates were much more lower. The TB was doing just about 1.5, 182 days was doing about 1.75. So when it came at about 9.83, that showed like the yield curve was very, very much low. Currently, that paper, the demand is doing about 10.3, 10.5. So we have not seen so much trading other than the trading that happened towards the last quarter of the year. So otherwise, for the 20-year paper, it's been very, very actively traded.
Yeah. So the 12% that the government is offering on this 30-year bond, how attractive is that in today's market, do you think? And also the size of the issue that they are looking at?
By the way, the 12-year percent is quite attractive. Mark you, this is a discounted paper. So what it means is, though the coupon is 12%, investors have the freedom to go from whatever rate, from at a premium below 12 or at a discount above 12. My whole hatch is it may just come slightly above 12%, maybe 12 to 12.25. Because again, out of the 18 billion, there are two papers being availed there. There's the 2-year paper, which is a market-determined coupon. After the market has applied for the paper, then the coupon can be determined. And within the same 18 billion, we have the 30-year paper. I got this feeling like we may get something like 20 billion of the bids chasing the 2-year, and just about between 5 billion to maybe 15 billion chasing the 30-year bond.
Indeed. Kobe, this is groundbreaking. So Kenya, for the first time in its history, offers a 30-year bond and is offering 12%. Sitting in South Africa as a person who looks after people's money, is this something that you'd be considering?
Okay, let's just quickly put this into a portfolio construction debate. Okay.
Go for it, Kobe.
I think, firstly, if you're sitting in Kenya today and you're trying to match liabilities that are 30 years out, and the 12% kind of makes sense to you in that market, then certainly this is something that you'd be looking at. Okay. But within a global environment, okay, we're coming off the back end of a global boom in bond issuance. So last year has been the biggest as far as bond issuance is concerned globally. And we're slowly starting to see a shift out of bonds and into equities. And that's slowly going to start happening because equities predominantly is a growth asset class, not bonds. Okay, even though bonds have been behaving like a growth asset class.
Yeah.
And on the back end of that, remember that inflation's starting to rise. And as inflation rises, interest rates have to go up to match those inflation rates, which means yields will rise and you'll get price pressure for bonds. And that's where you're not getting the appetite for bonds at the moment. Because people are saying, well, inflation's going to rise. Remember we spoke about this just now.
Yeah.
Inflation's going to rise, rates are going to rise, and then I'm going to get price pressure for bonds. So if I'm participating in this bond right now, barring that you're not trying to matching a liability far out if you're in Kenya, then I'm probably going to get some price pressure. And remember, when there's price pressure in the bond market, what happens? Well, people sell out of emerging markets first. They suck all their capital out of emerging markets, and South Africa is one of those. And then they go and they put their money into Western markets. And you potentially then sitting with massive fluctuations as far as yields is concerned. So there might be some investors that are saying, well, look, 12% is really, really attractive and I quite like it, but you know what? It might actually be 18% at some point, and then I'll buy it.
Yeah. Fred, the message that I'm getting from Kobe here is that people are moving more out of bonds into equities now, and perhaps the government hasn't quite timed its return into, it's time to offer this this issue into the market now. What's your sense in terms of foreign investor interest and participation in this issue?
By the way, something very interesting. We've never had a lot of foreign interest in the fixed income in Kenya. Just by the numbers, in the year 2008, the market did just about 98 billion. In 2009, the market did about 110 billion. Last year, 2010, the market did about 500 billion. Now, interestingly, we've never had a lot of interest from the foreigners. In fact, half of the times when we have had foreigners coming through, when they come through the custodians or some of the banks, they participate in the short end. I'll give an example. In Kenya, we have Barclays Bank, Standard Chartered, and Citibank. Those chaps only will play in this market from the 91 days and a maximum of 24 months. They never play on the long end. Now, coming back to the local scene, the situation is a bit different here because we see like for the last 6 months, the money market has been extremely very liquid. Banks, I think the overnight, we do more than 50 billion that money slips over without being invested. Right now, as we speak, the overnight rate is about 1.2%, way down from just about 2.5% just about 6 months ago. So we have a situation in Kenya where the banks have so much liquidity. When the funds and the pension scheme and the insurance companies go to deposit that money in the banks, they get almost nil. So you see a situation whereby that excess liquidity is the one that is going to be chasing this bond now. I know for a fact that interest rates probably due to the inflation, they're likely to go up. But the situation is a little bit different. I think if you look in the last 3 years to 4 years, the activity in the fixed income secondary market in Kenya has really been going up by leap and bounds. And the participation from the foreign investors have been very, very little, if any.
Quick question, Fred, before we wrap up this discussion. What kind of an impact do you see this having in terms of developing and deepening Kenya's capital markets?
I think it's going to have two effects. One, we have had cases whereby in Kenya most corporates are looking to do their corporate bonds, and they have been using the government as a benchmark. And I think a good example is Kenyan or Safaricom. When they came to the market, they're trying to look for between a 10-year, both of them were 7-year and 10-year respectively, and that was taken up. There's been a bit of a talk that either Kenya Power or East African Portland may come in the market and do a little bit longer paper, like a 15-year paper, to test the market. So I think that's one. Secondly, there's going to be a bit of impact when it comes to the lending rates in Kenya. I think for a long, long time, the government fixed income security has been a benchmark to which bank are going to use to lend on the housing market and even on the long end types of loans. And I think a 30-year coming and being capped at about 25%, then that means around that time, we should see banks probably benchmarking that one and using that one as a base lending for them to proceed and lend. So I think it's going to have those two impacts in the local market.